Bonjour and welcome. If it is your first time visiting this channel, please like, subscribe, and share. So today we are going to continue with ratio analysis. Okay? In the previous video, we covered how to prepare financial statement using or taking into consideration certain adjustments. So today, we are going to use a financial statement to do our ratio analysis. So we begin by defining what we mean by ratio analysis. So it is the use of accounting ratios to assess the performance of entity. It can be used to compare the firm to other firm, and it is also useful when comparing companies with different sizes. So these are the various uses of accounting ratios, okay? So based on our definition, if we are to be asked the importance or the advantages and then the disadvantages of ratio analysis, what comes to your mind? Okay, we talk about comparing the firm to other firms. So you realize that there can be some improved internal processes that may exist in other firms that may not be in your firm. So that can be one of the challenges, okay? And then when you are comparing firms of different sizes, you realize that in terms of machinery, it is possible that the bigger firm may have access to more advanced and robust technology compared to yours. And besides, you are using historical figures to go about your analysis. So these are disadvantages that comes along with using ratio analysis. So you can sit and then think about it. If I'm to use this for decision making, what are the pros and the cons? So that will take you to that. Okay. So now we are to identify the various types of ratios. So we have to identify the various types of ratios. So we've been able to identify 5 different types of ratios. And under each of these ratios, we have sub-ratios. Okay, we'll go into that. So the first one is profitability or performance ratios. We have liquidity, short-term solvency ratios, activity or efficiency ratios. We have the investment ratios, the gearing or long-term financial stability ratios. So under each of these headings, we have sub-ratios under each. It is important for us to be able to calculate some of them. So there are instances where you'll be told that using this, so they can tell you that identify 3 types of profitability ratios or identify some liquidity ratios or calculate investment ratios. So these are the headings, and then there are sub-ratios that can be found under each of them. So let's go into a practical demonstration of how to go about our ratios. So we've been given some financial statement, both our income statement and the statement of financial position. And you can go through and see the figures. And then we have been required that we should calculate each different types of ratios. And then the B is also saying that using the ratios that we have calculated, we should, from the perspective of an investor or a purchaser, we should be able to advise. Okay. So now like we said, there are various uses of ratios. Okay. So we have seen 2 types. We have seen 2 uses in our earlier presentation, but then sitting and then from a point of view of an investor, what do you make use of the ratio, or how do you make use of the ratios? So you can also think about that. So, okay, it is not always that it has to be written down in the book before you can be able to come out with the usefulness of it. So when you sit, from where you sit, if you're a creditor, where you sit, you're supposed to give out money to a business, or you're supposed to borrow a business with some funds. From your perspective, how is ratio going to be, useful to making that decision? If you're in government, where you sit as a government, how can you use ratios for informed decision making? So depending on which side you are, you can always come out with the pros and cons. Okay. So now on our profitability ratios, we have gross profit margin. Okay. And we've been given the formula. So all we have to do, just go into the financial statement, check out these figures. Gross profit margin is gross profit over sales. So we have to go and pick out what our gross profit is and what our sales revenue is. And then we can go ahead and then do the ratio straightforward. Okay, so that's just all about it. And then let me bring this to your notice. There are instances where there will be certain adjustments given in the additional information. So there might be adjustment to any of these figures. Remember in our last week or our last section, when we look at the income statement and financial position, we saw that there were some items that had been understated or overstated and we had to make certain adjustments. So the same can also apply. But then for this question, we do not have that. So we just go straight ahead to do our calculation. So now, it says that gross profit margin is equal to gross profit over sales. So we've been given two periods, year before last and last year. So we are considering year before last to be 2022 and then last year to be 2023. Okay. So now our gross profit is giving us 1,040 divided by 2,600 times 100. So this will give us 40%. So this will give us 40%. Okay? 40%. So when we come to 2023, our gross profit has been given at 1,150 divided by 3,500 multiplied by 100%. This will give us 33%. Okay, let's just run it up. 33%. Okay, so we talk about change. Why is change important in this instance? Change is important because we are trying to look at the impact of each of these figures in terms of business operations. So for instance, we have gross profit over sales. So when we look at gross profit for each of the period, we are trying to see why there are variances in the figures to help us in writing out our reports. So it is important at this point in time to be able to calculate the change. If you do this, in writing out, there are times where the question will require that based on the ratio that you have write out, that you have calculated, you should prepare a report, okay, to a potential investor. Write a report to them based on the assessment that you have made. So you can do groupings of each of the ratios. So we talk about profitability, group like terms and group unlike terms. So those that speak well of the business, you can group them into one. And then those that doesn't speak well of the business, you can group them into another segment. Okay. So now the change we are looking at, so I'm going to calculate one, you also do the other. So I'm going to look at gross profit. Okay. So you can also look at sales for that period. So what is a change between the sales figure? But I'm going to look at gross profit. You can do that on your own as part of your exercise. So our gross profit for the current year, calculating the change, it's 1,150 minus 1,040, the current minus the previous, divided by the current, which is 1,150. That's how we calculate change times 100%. So this will give us, let's say, 10%. Okay? So the change in gross profit is 10%, right? So we will proceed with operating profit. I'm going to solve about 3, then you continue with the others in terms of profitability ratios. So here we've been told operating profit margin. We'll just go into our financial statement and locate what our operating profit is. So in this instance, in 2022, the operating profit is the same as profit before interest and tax. So just in case you do not come across what an operating profit is, you can be able to find profit before interest and tax. It means the same, okay? For 2022, our operating profit is 310 divided by our sales revenue of 2,600 multiplied by 100%. This will give us, let's say, 12%. We are running them up 12%. And then when you come to the current year, which is if you come to the current year, which is 2023, as we've said, so we'll go on and then do the same calculation. So 2023, our operating profit is 350 divided by the sales, okay, sales revenue, multiplied by 100. This will also give us 10%. But remember, okay, this will give us 10%. Okay, so now let's go on to calculate the change. Okay, so remember, I'll calculate the change for this since you already know now how to go about the change. The rest you have to do them on your own doing practice. Okay, so now the change. So I'll look at the operating profit just as we did for the gross profit. Okay, so the current year operating profit is 350 minus 310 divided by 350 times 100. So there has been a change of 11%. Of 11% in terms of operating profit from the current year and then that of the previous year. So net profit margin, the same thing apply. Net profit the same as profit after tax, okay? Profit after tax or profit for the year, whichever you come across, it means the same thing. So to do that, we will find the profit for the year, 155 divided by the sales figure. So that will give us, let's say, 6%. Remember why we are using one whole number, okay? So, all right, let me just reconfirm that. That's 6%, no 5. So 6%, right? So now let's go into the current year. Profit for the year is 175 divided by 3,500 times 100. That will give us 5%. Okay, 5%. So you go on and then calculate the change. Okay, so just pick the next profit and then do that. So now we've been able to do this. So based on the change that you get, then you can then now write out your report. Or now we are being told that you are a purchaser, a potential investor, and then you want to acquire this business. What do you make of the figures? So what do you say? We've calculated the year before last figure, we've calculated last year's figure. So based on it, does it tell you that the business has a prospect or not? So these are things that you will look out for as you carry on your analysis. So you will work out the return on capital employed, okay? Profit before interest and tax is the same as operating profit. And then shareholders fund plus long-term debt. So these are the providers of funds, those who are giving you money to be able to operate the business. So we are saying that how much return are they going to get on their capital employed? Okay, so you as a purchaser, for instance, let's assume that you are not buying all of the shares and then you are going to buy just portion of the share. What does that tell you as a potential investor? How much return will the business be able to generate on your investment? So as you are writing it out, these are things you have to look out for. So we come to liquidity ratios. Liquidity ratios, we've identified some of them, okay? So we have current ratios, and we are being told that current ratios is equal to current asset over current liability. So it is to 1. So how many times can our current asset cover our current liability? Current liability are our short-term obligations. So remember this, they are our short-term obligation. Where do you find current asset and current liability? In the statement of financial position. So let's go there. So here, our current assets given to us in this question for 2022 is 735 divided by our current liability given to us. These are the current liability here over 400, and we are getting 1.8. Okay, so 1.8 is to 1. 1.8 is to 1. So 1.8 is to 1. So what does that tell you? It tells you that we are able to use our current asset to cover or to meet our immediate or our short-term obligation, which is a good thing, right? It's a good thing. So let's go for the current year. So the current year figure has been reported. So when we pick current assets for the current year, current asset has been given as 660 divided by the current liability of 485. This will give us 1:4, 1.4, sorry. So 1.4:1, which is still good, but we're seeing that there has been a drop in the figures. So you can do the change. There has been a drop in the figures. Current, so you can calculate that of current asset and then calculate the change that of current liability and then report on that. Okay, you can do that and report on that. So there has been a drop, which means that we were able to use our current asset in the previous year more to cover our obligation. But now this figure has fallen. What will account for this? So in writing out your report, these are some of the things that you have to bring into light to show that, yeah, you really do understand what you are doing, okay? And it also help you with more marks in examination. So the quick ratio, we are saying that excluding inventories, okay? How much, because inventory can go bad. It can go bad. You may not be able to use it. And then sometimes too, inventory take longer period of time to be sold. And besides, you need cash to pay or to take care of your obligation. You need cash. So we are saying that in the absence of inventory, how liquid are you? And how are you able to cover your obligations? So now, our current asset, we are going to deduct our closing inventory from it and to see how much, what is left to cover our, short-term obligation. So we know that the total current assets for the previous year, which is 2022, was given as 735. And now let's take out inventory. Inventory has given us 250. It means we are left with 485 divided by our total current liability, which is 400. So this has given us 1.2:1, which means that we are able to cover our inventory 1.2:1, which is a good thing. Still, I mean, we can still cover our short-term obligation, okay, regardless. So now we'll do same for the current year. We will do same for the current year. So within the current year, the total current asset is 660 minus inventory figure reported as 400, which is 260, divided by our current liability of 485. Whoa, this has dropped to 0.5. So that's not a good thing. So 0.5 is to 1. Is to 1, which is not a good thing. So it means that in the absence of our inventory, this is how much, or this is a portion of our current debt that we can be able to take care of. Remember, there are times when creditors will come on you. Remember, let's see the components of the current liability. So the components here, we have trade payables, those that we've taken goods from on credit. Imagine they just come to you that, okay, I need my money. Your time is due. How would you be able to pay for that? So as an investor, how do you advise yourself on this? So now we will talk about inventory turnover. So it is an average inventory over cost of sales, okay? So there are instances where the question will provide you with both opening and closing inventory. You add the two and then find the average of it. But in this question, we have not been given that. So we will restrict ourselves to what the question is. So our average inventory, we'll be looking at the closing inventory, okay? So it is average inventory over cost of sales. So what is our closing inventory figure? So in 2022, inventory was reported as 250, okay, over cost of sales. And then the cost of sales figure reported here is 1,560. So 1,560, right? Let's check that again. So, and then we have, so the figure that we'll get, we multiply it by 365 days, giving us, let's say 9 days. 9 days. How long does it take us to convert our inventory? Okay, how long does it take us? So we come to the current year. Our closing inventory for the current year is 400 divided by our cost of sales figure, giving us 2,350. This is the cost of sales figure, okay? Times 365, giving us 62 days. That's a whole lot. That is a whole lot. So 62 days. 62 days. So let's just reconfirm that figure. That's a whole lot of days. So our closing inventory figure was giving us 400 divided by our cost of sales figure of 2,350 multiplied by 365. Yeah, that's correct. So let's just reconfirm the 2022 figure. So our closing inventory was giving us 250 here divided by 1,560 times 365. So that is 58 days, right? So we just do the corrections. So 58 days. Perfect. I think that's more realistic. Okay, so then you calculate the change between the inventories to be able to make meaningful judgments about the figures. So debtors collection period, how long does it take for us to be able to collect money, our monies from those who are owing us? Okay, so debtor collection, sometimes if you don't see debtor, you will see what? Receivable, those who are owing you. So that is average receivable over credit sales. So like I said, there are times when you will be given both the opening and the closing, and you have to strike out the average to go about it. So this question, we do not have that. So we'll go straight to our statement of financial position. That's where we can find trade receivable, which is the same as debtors. Okay, so here, the trade receivable for the current year, it is for the 2022, sorry, it is 105, okay, over our credit sales. So now, watch out for this. Our credit sales are goods we sold on credit, the total figure. But this question did not separate our sales revenue. It did not give us information whether there's some proportion of the sales revenue that has been allocated to credit sales, and there are some that's been allocated to cash sales. So where the question makes it more obvious, you can go on and use the credit sales figure. Where it is not provided in the question, you kindly go on to use the sales revenue figure, okay? Sales or revenue, sometimes they can be used together, separately, or interchangeably. So 105 divided by 2,600 for 2022 times 365. So it takes us 15 days. 15 days. Okay? So 15 days. 15 days. That's how long they take us. So we will do that for 2023. 2023 here, our trade receivable is 145 divided by the sales figure of 3,500 multiplied by 365, giving us 15 days. Giving us 15 days. Right. Remember, we have rounded up the other figure, but then this one gave us 15 days straight away. That was 14 point something, and then we rounded it up, which is still not bad. Still not bad. So then you can go on to calculate the change. So I will leave the trade payable with you. So the same thing. There are times when you'll be giving credit purchases. How much of your purchases has been due to, trade purchases? It means that credit purchases, sorry. It means that you have bought goods on credit. So you are owing. So there are times when the question will be explicit. It will be explicit. It will give you the actual figure that goes into, credit purchase. They have to use that. Also calculate the change for better reporting. So we come to activity ratios. So activity ratios, it is a total sales to total assets multiplied by 100. So the formulas have been given. Just go through them and then you can go on with the ratios calculation. So you see total sales. So it means we can have credit sales and card sales. So 2,600 for 2022. It says that total sales here over total asset. Total asset, it is both current asset and non-current asset. So it's here total asset, which is 2,000. You get it, 2,000 times 100. Let's do that again. So our total sales figure here has been given as 2,600. And then our total assets figure, let's see this again. Total asset figure has been given as 2,000, okay, which is 13 times 100, right? So 13, we can say 13%. This is huge, but then we have to report it like that. So this is 13, right? So let's report as 13, right? Into percentage, you give us 1,300. Obviously, we divide it by 100, okay? So we do same for the current year. The current year, we have been given our total sales figure. The total sales figure given to us, it's 3,500 divided by total assets. And then total asset here is 2,185 times 100. So this gives 160, right? 160%. Okay, so I think we will have to so 2,600 divided by 2,000 is 1.3 times 100. So let's correct this. This is 130. Okay. This is 130. Right. So this is 130, pardon me. So we were given our sales figure 2,600 divided by 2,000. 1.3 multiplied by 100, so 130%. So this one to give us 130%. So let's just reaffirm that. So sales 3,500 divided by total asset 2,185. Okay, 1.6. So this is 160%. Okay, 160%. So now you can go on to calculate your change, right? So what does it tell you? Sales to total asset ratios. You can go on and then do the change. So under activity ratios, you can also calculate for inventory turnover, debtors collection period, or trade payable settlement period. So these ratios can also be found under activity ratio. So just in case you are being told that you should calculate maybe 3 or 4 different types of activity ratios, you can place them on. But because we've already done the calculations, I'm not going to repeat it over here under liquidity ratios. Okay, so now investment ratios. We are saying that it is profit after tax minus irredeemable preference dividends over total number of ordinary shares in issue. So now our profit for the year, it is the same as profit after tax, this figure over here. And then we've not been given any figure for irredeemable preference shares, so we assume it to be 0. So 155 minus 0, okay, which is still 155, right? So now we are going to look at how much of a share that is in issue. So we go to our balance sheet. We've been told that each share is worth £1. So it means that it's 490 divided by 1. There are times where it can be 0.5, meaning you have to divide it by that. So it means our total share in issue is 490. So divided by 490. Okay, so that will give us 0.32. So here, 0.32. And then we also calculate that of the current year. Remember, the share capital is the same. The price is the same, okay, for one share. So it's the same for 90. So we have to concentrate on now. It is our profit after tax or profits for the year. Remember, the irredeemable preference share is 0. So 175 divided by 490, giving us 0.34. 0.34. Okay, so 0.34. So it means that for each share that you own in the company, this is how much you are going to earn per share as a shareholder. That's what it's telling you. Okay, this is how much as a shareholder, this is what it's telling you. How much you earn on each share that you own in the company. So as a potential investor, you are actually interested in this figure. The higher the better. At least it tells you that there is bigger prospects or there is a possibility that you earn more as a result of your investment. Okay. So dividends per share is the same thing. Here they said dividends were paid on ordinary share of 65 million and 75 million in respect of the year before last and then last year respectively. So let's do that. Dividend per share, it is total dividends over total number of ordinary share in issue. So we've been told that the dividend in 2022, it is 665 million. Okay, our total share in issue is 490. So it is 0.13. 0.13. Dividends per share, 0.13. That's how much dividend that will be paid, on each share that you own. Dividend per share. So now we will do that of the current year. We've been given 75 million divided by 490, giving us 0.15. Meaning that business has a growth prospect, because if you are being paid 0.13 proportion as part like dividend on each year, and now it has increased to 0.15. That's a good thing. Okay, that's a good thing. So we can also calculate the PE ratio, price per earning ratio, and price earning ratio, sorry. So that is our market price per share divided by earning per share. We've not been given market price per share, but just in case the question provide you with that information, kindly make use of it. And then you can also calculate for dividend yield, dividend per share over market price per share, or any yield, any per share over market price per share. So the formulas have been given to you, so you can make use of it just in case you have additional information that has given you what the market price per share is. So now for gearing ratios, we are going to look at two. Remember, we also have how do you call it? Right. So you can have other types of ratios and like gearing. Okay. We can have operating, or, we can have operating also under it. So now we have fixed interest cover here. And then we've been given the formula to be profit before interest and tax, which is our operating profit, over finance or interest cover. Now, how do you calculate for interest cover? So interest cover, it is profit before interest and tax over, okay? So let's do this first. Interest cover, it will be equal to EBIT, operating profit, over interest expense, okay? Expense. So in this question, our profit before interest and tax for the current year, what is it? For the current year, our operating profit for 2022, pardon, 310. So how much did we pay as interest? It was 50, right? Which is 50, which is 6.2. So how many times can our profit cover our interest payment? That's basically what it means. How many times can it cover our interest payment? So 6.2 times, okay, for the current year. So now let's go into our question. It says that profit before interest and tax over interest cover. So we've already gotten the figure for interest cover. That will give us, let me just type it out here, 6.2, right? Yeah, this is for 2022. So now that means that our interest cover now, it will become, profit before interest and tax, 310 divided by 6.2, giving us 50. You get it? So it's giving us 50. So profit before interest and tax over finance or interest cover. So this is 50. Fixed interest cover, okay? And then we'll do same for the current year. So 2023 here, let's calculate that one as well. Our operating profit has been given as operating profit has been given as 350 divided by our total interest of 50, which is 7 times, right? So 7 times. So this will give us 7 times, right? So now we are supposed to calculate the fixed interest cover. So this will be profit before interest and tax divided by 7. So profit before interest and tax here, it is 350 divided by 7, giving us 50 as well. So this is fixed over the period. So what does that tell you? So you can go on and also do your calculation for fixed dividend cover. Okay? So these are the various kind of ratios that we've been able to identify under each of the headings. Remember, we had identified 5 different types of ratios, and these are the sub that we've been able to identify under each of them. So now you are being, from the perspective of a purchaser, based on the figures that we have gotten, would you advise yourself to carry on or to carry on with your investments? So based on the figures that we have calculated, you have to make a decision. This is where it is important. And if you are being asked to write a report, what do you write? What recommendations will you give? What are the risks that the business may be exposed to? What are the internal inefficiencies that the business is facing? What can the business do, to improve upon the figures that you have gotten? So these are things that you have to factor in as you are doing your analysis, as you are going to advise someone, or as you are advising yourself as a potential investor. Thank you so much for the time spent. This brings us to the end of today's lecture. It's always been great having you around. So kindly do not forget, okay, to like, subscribe, and share this video. We have more interesting content coming your way. Thank you so much, and bye-bye.